Your paycheck jumps from $3,800 to $4,500 a month, and suddenly you feel richer until you stare at a bank statement that shows you're still broke. That extra $700 didn't buy you freedom. It bought a new habit that will keep your savings stuck at zero. Let's pull back the curtain on the money traps that keep the middle class from getting ahead. I'll walk you through each one, show the math, and give you a single step you can take right now to break free. By the end, you'll see how these pitfalls look harmless until the numbers add up, and you'll have a clear plan to keep more of what you earn. First, lifestyle inflation. It's the tendency to spend any increase in income on a fancier lifestyle instead of saving or investing. Most people think a raise is a reward to be spent, a nicer car, a bigger apartment, a weekly dinner out. The mistake is believing that higher spending is harmless because the paycheck is bigger. In reality, the extra dollars disappear as quickly as they arrive. Imagine you get a $700 raise and you upgrade your rent from $1,200 to $1,500. Buy a $250 monthly gym membership and start ordering food delivery twice a week at $30 each. That's $700 in new expenses, wiping out the entire raise. If you'd saved that $700 and invested it at a modest 7% annual return, after 20 years you'd have about $480,000. The daily choice to treat yourself each month is the difference between a modest nest egg and a sizable one. Action. As soon as you get a raise, automatically route at least 30% of the increase into a high-yield savings account or retirement fund before you look at the budget. Next, credit card minimum payments at a 21% APR. Paying only the small required amount each month keeps the balance growing because interest accrues faster than you reduce the principal. Most people assume the minimum payment is enough to stay in good standing, but they overlook that the interest on a $5,000 balance at 21% compounds. You'll pay roughly $2,100 in interest over 5 years if you only make the minimum payments. The balance shrinks slowly, and the debt becomes a long-term money drain. Take a realistic scenario. You owe $5,000. The minimum payment is $150, and the APR is 21%. After 1 year, your balance is still about $4,800, and you've paid $700 in interest. After 5 years, you'll have paid roughly $2,200 in interest, and the principal will be only $2,800. That's $2,200 that could have gone toward a down payment on a house or a retirement account. Action. Set a goal to pay at least twice the minimum, or better yet, aim to clear the balance within 12 months. Use a budgeting app to earmark a debt payoff line and treat it like any other bill. Buy now, pay later, BNPL, plans are the next trap. They let you split a purchase into interest-free installments, often marketed as no cost. People misread the zero-interest promise as free money, forgetting that the real cost is the pressure to spend more than they can afford and the risk of late fees or credit score hits if they miss a payment. The hidden expense is the opportunity cost of money that could have been invested. Picture a $1,200 smartphone upgrade split into 4 $300 payments. You feel fine because you're not paying all at once, but you also forego the chance to put that $300 each month into a retirement account. If you invested $300 monthly at 6% for 30 years, you'd end up with about $500,000. Instead, you spend $300 now, and the remaining $900 sits idle, not earning anything. Action. Before you click buy now, pause and ask if you truly need the item, and if you do, pay cash or use a debit card so the cost is immediate and you can allocate the rest of your cash toward savings. Now, 72-month car loans on depreciating cars. Financing a vehicle over 6 years sounds nice, but cars lose most of their value in the first 3. The misunderstanding is that a low monthly payment equals a good deal, ignoring that you'll owe more than the car is worth for several years. A typical new car loses about 20% of its value in the first year and 50% after 3. If you finance $30,000 at 5% for 72 months, Your monthly payment is roughly $460. After 3 years, the car's market value might be $15,000, but you still owe about $22,000. You're upside down on the loan, meaning you keep paying while the asset shrinks. Let's break it down numerically. Borrow $30,000, 5% APR, 72 months. Total interest paid over the life of the loan is about $3,500. After 3 years, you've paid $16,560 in principal, leaving $13,440 still owed. Yet the car's market value is only $15,000, so you have just $1,560 equity, a thin cushion that disappears if you need a repair or want to trade it. Action: aim for a loan term of 48 months or less, and put a larger down payment, at least 20%, to keep the loan balance below the car's depreciated value. Subscription creep is another silent drain. It's the accumulation of recurring monthly fees for services you barely use. People think each subscription is a small expense, and they forget that together they add up. The mistake is treating each $5 or $10 charge as negligible, ignoring the cumulative effect over a year. According to a recent survey, the average household spends $245 per month on subscriptions they either don't remember or rarely use. Take a concrete example: streaming video $12, music $10, a meal kit service $15, a fitness app $9, cloud storage $5, and 2 premium app versions at $4 each. That's $49 a month, or $588 a year. If you invest that $49 monthly at 7% for 15 years, you'd have about $190,000. The money you think is just a little something could be building a solid investment. Action: audit your bank statements, list every recurring charge, and cancel any service you haven't used in the past 30 days. Set a reminder to review this list quarterly. Extended warranties sound like protection, but often act as insurance you never claim. They're an additional contract, usually sold at the point of purchase, that covers repair costs beyond the manufacturer's guarantee. Most people assume the warranty will save them money if something breaks, but only a tiny fraction of owners ever file a claim, and the cost of the warranty typically exceeds the repair expense. Suppose you buy a $2,000 home appliance and are offered a 3-year extended warranty for $150. Over the next 3 years, the average repair cost for that appliance type is $80. Even if your unit fails, you'd be $70 out of pocket, plus you've already spent $150 for coverage you never needed. If you'd invested the $150 instead, at 6% for 10 years, you'd have about $270. Action: skip the warranty unless the product is known for frequent failures, and instead set aside $150 in an emergency fund for any unexpected repairs. Keeping up appearances on social media versus the new quiet saving trend is a cultural trap. The pressure to showcase a lavish lifestyle online leads to overspending, while a growing movement of discreet financial discipline pushes the opposite. Many people think posting a fancy dinner or a new gadget validates their success, not realizing they're buying status, not security. The misunderstanding is that external validation translates into real wealth, when in fact it often forces you to spend money you don't have. Imagine you allocate $200 a month for Instagram-worthy experiences, nicer restaurants, new clothes, weekend trips. Over a year, that's $2,400. If you redirected that to a tax-advantaged account, you'd have $2,400 plus the tax benefit and potential growth. At a 5% return, after 20 years, you'd see roughly $85,000. Action: set a personal rule to spend no more than 10% of your discretionary income on social media-driven purchases, and channel the rest into a savings vehicle you won't brag about, but will benefit you later. Leaving employer retirement match on the table is a huge missed opportunity. It's not contributing enough to your 401k or similar plan to capture the full percentage your employer will match. The common error is thinking you can catch up later forgetting that the match is essentially free money you lose forever if you don't claim it. Consider a job that offers a 4% match on a $60,000 salary. If you contribute only 2%, $1,200, you receive $480 in match. If you increase your contribution to 4%, you get the full $2,400 match. That extra $1,920 per year, compounded at 7% over 30 years, grows to about $2.3 million. The match alone can be the difference between a comfortable retirement and a precarious one. Action: adjust your contribution to at least the employer match percentage as soon as you can. The payroll system will handle the rest automatically. High-fee investment funds eating compound growth are another hidden drain. They're mutual funds, or ETFs, that charge high expense ratios, reducing the net return you actually earn. Many investors think a fund's performance is all about its gross returns, ignoring that fees are taken out before the money compounds. The mistake is assuming a 9% return is the same as a 9% return after a 2% fee. Take two portfolios, one in a fund with a 0.1% expense ratio, the other in a fund charging 2%. Both start with $10,000 and earn a 9% gross return annually for 30 years. The low-fee fund ends up with about $140,000. The high-fee fund, after fees, ends with roughly $84,000. That's a $56,000 difference, money lost solely to fees. Action: switch to low-cost index funds, or ETFs, with expense ratios below 0.2% and watch your long-term wealth grow faster. Payday-style short-term loans are the final trap. They're high-interest, short-duration loans often advertised as cash advances for emergencies. People assume they're a quick fix, forgetting that APRs can exceed 300%, and the repayment schedule forces you into a cycle of debt. The misunderstanding is viewing the loan as a one-off solution, not a financial sinkhole. Suppose you borrow $500 with a 30% APR for a 4-week term. The lender charges a flat fee of $75, plus a $15 processing fee. That's $90 total, or 18% of the loan amount in just 1 month. If you rely on this repeatedly, you could be paying over $1,000 in fees a year while only borrowing $500 each time. Action: build an emergency fund of at least $1,000 and keep that fund in an easy access account. When a surprise expense arises, use your own cash instead of a payday loan. All these traps add up to a staggering picture. U.S. household debt just topped $18 trillion, and inflation is hovering at 3.8%. The numbers can feel overwhelming, but each trap is designed to look harmless while silently eroding your wealth. The math is simple. Every dollar you lose to a trap is a dollar you can invest, a dollar that won't compound, a dollar that won't build your future. Now, let's line up the exact steps you can take today, one for each trap, so you can start turning the tide. 1. For lifestyle inflation, set up an automatic transfer of 30% of any raise into a separate savings bucket before you touch the rest. 2. For credit card minimums, calculate the total interest you'd pay if you only made the minimum, then commit to paying double that amount each month. 3. For BNPL, wait 24 hours before finalizing any purchase and ask yourself if you could buy it outright with cash. 4. For long car loans, refinance to a shorter term or put down a larger down payment to keep the loan below the car's depreciated value. 5. For subscription creep, schedule a monthly subscription audit night. Cancel any you haven't used in the past month and redirect that money to a high-yield account. 6. For extended warranties, place a repair reserve in your emergency fund instead of buying the warranty, and only buy coverage for high-value items like electronics if the manufacturer's warranty is short. 7. For social media spending, set a cap of 10% of discretionary income on Instagram-driven purchases and automatically funnel the rest into a retirement account. 8. For missing the employer match, log into your payroll portal, and bump your contribution up to the match percentage right now. 9. For high-fee funds, review your portfolio, pull any expense-heavy funds, and replace them with low-cost index ETFs. 10. For payday loans, open a separate rainy day savings account. Deposit $50 each payday until you have $1,000, and keep that as your first line of defense. When you look at these actions together, they form a roadmap that's as simple as an ant marching back to its colony with a grain of food. Each grain may seem tiny, but when the whole colony works together, they build a massive store that sustains them through droughts. Likewise, each small financial habit you adopt will accumulate into a robust safety net that shields you from the next economic storm. Remember, the traps are built to feel invisible, but the math is clear. By recognizing the hidden cost, adjusting your behavior, and automating the good moves, you'll start to see the balance shift. The next time your paycheck rises, let the extra money work for you, not against you. The next time a flashy subscription pops up, ask if it truly adds value, not just status. And the next time you're tempted by a quick loan, reach for the emergency fund you've built. You have the power to break each of these cycles, one deliberate choice at a time. Keep the focus on the long-term growth that comes from small, consistent actions, and watch your financial picture transform from stuck to thriving.